I hope everyone is okay. Today's session I'm going to give you the more explanation about the course of Advanced Financial Management. I'm by name Simon Evarist. As you see in my presentation, I'm a student of University of Rwanda in College of Business. I'm BBA student in finance, and also I'm CPA student from ICPAL. By today, we are going to look about advanced financial management. Today's topic, we are going to study about investment appraisal. This is a good course in this, and also it is a good topic. So the first of all, we will look about the discounting factor, DSF, discounting factor. After that, we shall look about the use of free cash flow. Don't worry, I'm here to give you the more detail and more explanation. First, let us look about learning outcomes. Here, the student should be able to determine the free cash flow. This is the first one. In determining the this first free cash flow, students again will be able to apply advanced investment appraisal techniques and deal with inflation and taxation. Here in this course, we are going to look about investment. You have your money, you are planning to invest, and also you are going to deal with inflation and also taxation. How it's gonna affect your investment. You will also ask yourself, should I invest? Yes. Next, we shall look about the value a firm using free cash flows. Talk about it is like the importance of using free cash flow. The next, the students will be able to get in this course. We'll call out investment appraisal and capital rationing. Investment appraisal, it is about taking a decision where to invest our money. Here, another things is about capital rationing. Capital rationing. When I say the capital rationing here, you start to realize I have the 3 millions, but I have many projects. I have project A, B, and C, but I have 2 million only. What you are going to ask yourself, how many in each project I'm going to invest? We shall deal with this calculation in detail, where in this course we should apply about the linear programming. Linear programming is about to invest for the sources available. If I have 2 million, as I said, how many I'm going to invest in the project A, how many I'm going to invest in the project B and C. Another things the students will earn is about determining you should also earn about determining the modified internal rate of return. When you say about modified internal rate of return, modified internal rate of return of an investment, that is modified to account for difference between the investment rate and investment return. You have invested, you have again the returns. You are going to look about the difference. In this method of modified internal rate of return, it should also develop the unique, and also you can deal with the difference borrowing and reinvestment rate. You give the same ranking and the standard net present value upload. So it is simple. We shall see about this. What the students will earn, should also know about to apply the simultaneation in investment appraisal and advise company. Here the students can earn the knowledge and skills of advising the company. Another thing, after completion of this topic of investment appraisal, the students will also know about call out option pricing. Okay, thank you. Let's start with free cash flow. You can ask yourself, what is free cash flow? That is a big question, but so we are going to see. The free cash flow is a cash that is not retained and reinvested in the business. It is a cash that is not retained and reinvested in the business. You have a cash, you are not going to keep it there, but you are going to reinvest it in investment. Free cash flow, it represents cash flow available to all the providers of the cash of the company, of the capital of the company. Sorry, the providers of the capital of the company are shareholders, a banker, are a lenders who provide the capital for our company. And another, it represents the cash flow available to pay dividends or finance additional capital projects. Meaning that here the cash flow, this free cash flow, it represents all things. It is going to represent, or it's going to present the cash flow available to the providers of the capital of the company, meaning that the shareholders. Another things, it is going to show us the cash flow available to pay the dividends or finance additional capital project. So simply, we are going to look about how to calculate this free cash flow. It is local like a West. Free cash flow is equal to revenue minus cost minus investment. If the company is working, it's gonna to earn the cash inflow. The cash is gonna come in a company. That is the revenue. If the company is working, it's gonna spend some amount of money. That's what we call the cost. It's gonna to incur the cost. It's gonna pay the revenues. It's gonna pay the different activities. It's gonna pay tax. And also, if a company is going to start, they have to invest some amount of money. So to get the free cash flow, you have to take revenue minus cost minus investment. The free cash flow used to evaluate investment project are therefore essential the net relevant cash flows. Therefore, we have look about the free cash flow, the definition, the cash that is not retained and invest in the business. Here, the net relevant cash flows associated with the project are the free cash flows it generates. So the discounted free cash flow are totaled provide net present value of the project. If you are take that revenue, you are going to less the cost, you are going to less investment, you are going to discount that net, the free cash flow, and you discount it. You are going to discount like 0.1. That is a discounting factor in order to get net present value of the project. Okay, thank you very much. This was presentation, but tomorrow's session we are going to explain about the project appraisal, about dealing with inflation, dealing with the tax. So make sure you have subscribed about this channel, and God bless you. Continue to make subscribe and share for other students in order to gain the more skills about this chapter. Thank you. Hello to everyone. Welcome to day 2. It is continuous session. This webinar. This is the day 2. We are still about advanced financial management. I'm still Saimana Evarist, student of University of Rwanda, College of Business, from BBA students in finance, and also I'm CPA student from ICPAL. That is my email button, gisevlazon@gmail.com. There is another phone number. You can contact me, you can WhatsApp me, 2050 78 11 11 4 1 and 6. Let us continue about what I have promised you for day 1. In day 2 we are going to look about the project appraisal. Today we are going to deal with the following: the impacts. We are going to look about the inflation, about the impact of taxation. So in this session we are going to look about the inflation, and we are going to do an exercise in order to understand well. Let us look at the impact of inflation. First of all, what is inflation? Inflation is a general increase in the price leading to a general decline in the real value of money. In a time of inflation, the fund provider, someone who provides the fund, will require a return made up of 2 elements. If you provide a fund to the company, you need 2 elements of returns. The first of all, you need a real return for the use of their fund. For amount of money you have invested in a company, you need a real return to use your fund. Assume if you buy share in a company, you need a return, a real return. Meaning that you need that fund you have provided for that company in a current price. Additional return, you need additional return to compensate for inflation. If you have invested 1,000 and the inflation happening, the company is going to compensate you. There's some additional inflation that happened for your investment. This is the formula where we use when you are calculating the nominal rate. So the formula, we take 1 plus I, which is equal to 1 plus R multiplied by 1 plus H, where I it is a nominal rate, R it is a real rate, H it is inflation rate. So you can calculate the one things if they ask you to calculate like real rate. In order to calculate the real rate, you have to take 1 plus R which is equal 1 plus I divided by 1 plus H. That is the formula to find the real rate. Let us look about the types of cash flow. There are two types of cash flow. We have real cash flow and nominal cash flow. When we are saying about the real cash flow meaning that the cash you are generating or cash that has gone that you are spending are in current price. When you are calculating about the for the project, or you are going to calculate the returns, you should discount in real rates. Discount the real discounting rate, which is a return ignoring inflation. You are not to include inflation in your current price, in your cash flows. That is for the real cash flow, where it is not incorporated by inflation. Nominal cash flows, meaning that the actual expected cash flow at the future price, meaning that cash flow you are expecting in the future price for the next period, the price will be increased. You including inflationary increasing should be discounted at the nominal discounting rate, which is the rate relating to the current market rate of return. Meaning that if in the transaction they are saying that that amount of money and forecast to be like this, inflation is going to be forecast, revenue will increase like 10%, that is a nominal cash flow. Nominal interest rate incorporated inflation. When the nominal rate of interest is higher than the rate of inflation, exactly, there is a positive real rate. When the rate of inflation is higher than the nominal rate of interest, the real rate of interest will be negative. Do you understand? So let us look at two types of inflation. Actual, we know this, it is well known. We have a specific inflation rate and we have general rate of inflation. If in a country there is a specific inflation rate, meaning that impacts all individuals' cash flow items, each cash flow is affected by a specific rate. For general rate of inflation, it impacts the investors over a required rate of return. Here for specific it is impact for all individuals. Here it is only for investors. For here, for general, the investors in the project need to compensate for their lost purchasing power. If someone invests in your company and the purchasing power lost, meaning that you are going to compensate, which relates to the ability to buy a basket of all goods rather than any specific one. There are two methods to deal with inflation. The methods are two: the real method and the nominal method. As I said previously, in the real you do not incorporate inflation, but in the nominal you are going to incorporate, you are going to inflate that cash flows. So here, if it is a real method you are going to use, you do not inflate the cash flow. The money you are generating or the cost you are incurring, you do not incorporate, you do not inflate. So leave it in the real terms. You are going to leave it in today's as price. After that, after to leave it, then you discount by using the real rate, and then you get the real. For nominal method, you are going to inflate each cash flow. If there is a revenue you get, you're going to inflate. If there is a tax, you're going to inflate. So for each specific inflation rate, If there is a real rate, you are going to convert into the money flow, and then after you discount by using the money rate and you get the money. You have to be consistent. This is an exercise we are going to discuss for today and to collect it. So because it is long, we are going to let, and then we are going to start by working for each in order to make it clear and everyone understand well. So an exercise, they're saying that a company is considering investing $4.5 million in the project to achieve an annual increase in the revenue over the next 5 years of $2 million. The project will lead to an increase in the wage cost of $0.4 million per year, meaning that the cost is going to be incurred in each year, and that revenue is going to increase in every year until to 5 years, meaning that this project is gonna to be in 5 years, and this company is considering to invest 4.5 million as we have laid. So the project will lead to an increase in the wage of 0.4 as we have said per year, and we also require an expenditure. We will also require an expenditure of 0.3 to maintain the level of existing asset to be used on the project. The company will require the 0.3 million for each project in this year, every year. Additional investment in working capital equivalents to 10% of increasing in the revenue will need to be in a place at the start of each year. If you are going to start for year 0, we are going to calculate 10% result from the revenue. The following forecasts are made of the rate of inflation each year for the next 5 years. This is the forecast, what they are forecasting to have for inflation. Revenue will increase by 10, wage 5, assets 7, general price 6.5. The real cost of capital of the company is 8. They are saying it is real, it is not nominal, because we are forecasting, meaning that it is a future price. So we are going to convert it into the nominal rate of cash flow and in real term. They are saying that ignore the tax. Required, find the free cash flows of the project and determine whether it is worthwhile. Determine whether the project is going to be happen, where the project is available. So let us go to the collection. Well, we are going to look for, this is the data given. They are given in our question and question investment, which is equal $4.5 million. 11 is a 2M, which is going to increase over the 5 years, as the question said. Cost is 0.4 million per year. The cost we are going to incur each year $0.4 per year, and expenditure is of 0.3 to maintain the assets. So working capital, it will be 10% from the revenue increase by starting the year, meaning that in the year 0 we are going to have 10% result from the revenue. Forecasted inflation, as I said, 11 to the 10%, wage is 5%, assets 70%, general price 6.5. the real cost of capital of the company is 8, as we have said. So let us continue for the workings. Before going to the workings, you have to remember this. remember free cash flow formula. Remember the inflation, impact of inflation formula. The free cash flows equal to revenue minus cost minus investment. In our question, we have seen the revenue, we have seen the cost, we have seen the investment. So let us continue for the answer. For the answer, let us request everyone who is looking this video to take his calculator or her calculator. For working number 1, we are going to look about the revenue increase. I have two tables. One table shows the time, year 0, year 1, year 2, year 3, year 4, and year 5. Revenue not inflated, meaning that as you have rated in our question, revenue which is not inflated, it was 2 million in a per year. So we are going to inflate. So we are going to use this formula in a table 2, where they said that the revenue increased, inflated by 10%. So we are going to take the amount in year 1, then we multiply the amount this you have seen previously, and you multiply by 1 plus I, means inflation times the time. As you have seen, for the first year we get 2,200 as a calculation, year 2, year 3, year 4, year 5, and year 6. For the working tool, we are going to look about the capital retention. We are going to look about the working capital required, meaning that in our question they said that additional investment in a working capital equivalents to 10% of increase in the revenue we need to be in a press at the start of each year. As we have seen in working 1, we have said that we have get that the revenue in year 1 it is 2,200. Year 3 there's amount as we see up to year 5. We are going to deduct working capital of 10% in each year, where we are going to take revenue times 10% for each year. But the first year we goes in year 0, where we are going to take the 2,200 times 10%, and we get 220. This is a working capital we get. But for this working, we need this. When you are getting working capital, meaning this, that working capital is going to be deducted, as we have seen for the formula of free cash flow, where we are going to take the year 0 minus year 1, where we get 2,220 minus 242, and we get 220. This is for the first year. For the year 0, it will continue to be 220. For year 2, for year 1, we are going to take 2,000, or previously 220 minus 242 in the year 1, and they get 22, and continue applying this formula. So this will be like incremental. So it will be like incremental, meaning this is a working 2. For working 3, we are going to calculate the cost of capital. We need to convert the real cost of capital into nominal. As we have seen previously, the formula of inflation, it is 1 plus I equal 1 plus R times 1 plus H. I, it is the nominal rate,
R is the real rate, H is inflation rate, where R equal 8 in our question, meaning the real rate is 8%, H inflation rate is 6.5%. So we use this formula. As we see, I have calculated and I get the 15% to be using in discounting. Let us continue for working for. Working for, it is about the wage cost. Wage cost means the wage cost increased. For wage cost per year, it was 400 million in each year. Year 1, year 2, all it was constant. But to increase wage inflated by at 5%, we are going to use this formula as you see. I think it is self-explanatory. Let us continue for working 5. Working 5, it is about the asset replacement spending. In our question, they said that they will require expenditure of 300 million per year to maintain the level of existing asset to be used on the project. Meaning this per year, this is not wage cost, it is the expenditure, not here wage cost. So expenditure it is 300 per year, which is a constant up to year 5. So we are going to inflate. Always we use this formula. Amount multiplied by 1 plus I it is the interest, I it is the inflation rate, power time. As you see, this is the working 5 solution. Then we continue for our answer. So our answer, as you see, the first, this is the time, here 0, or you can say time 0, time 1, time 2, and I'm going to put inflation. Remember formula of free cash flow. It is revenue minus cost minus investment. Here it is what we are going to apply. For working 1, I'll get it is a revenue, where in year 1 we get this, and wage cost. You see, this is a cost. It is from the working for, where you are going to put it from each year. And after that, we get operating cash flow. If there is a tax, you have to subtract, and you get net. Net free cash flow. So you are going to deduct the investment. Our investment was 4.5 million USA dollars, meaning we have started our business. That is why we subtract from year 0, not each year. In each year you are not investing. So, and then you see it is expenditure we made to maintain our assets, the working 5, where we get this and this from each year. And then we go about the working capital. Working capital, it is like an additional investment. From working to, we have said in year 0 it is 220, and you continue until it's until year 4. And this working capital will be back in year 5. That is why we put the whole amount here in year 5, and then you subtract from operating. You take operating cash flow, multiply, you raise an investment, you raise cash, asset replacement, and then after you get working capital, you less it. After that you get free cash flow, and then you take the present value factor of 15% from working 3. As I have said, it is a 15% that you are going to make discount for each year from the tables, and then we get the present value free cash flow. After that, we conclude if the project is worthwhile. Our net present value is 1,390, which,
and also subscribe for once. If you are viewing this video once, please subscribe. My God bless you. This is Apatech TV. You have to subscribe.